Hello and welcome everyone today to NinjaTrader Ecosystem webinar event with David of Polaris Trading Group. My name is Tiffany and I am a platform representative at NinjaTrader. We have a very special event for you today with David of Polaris Trading Group. I would like to mention that it is important to understand that there are substantial risks in trading commodity futures, contracts, and Forex. You should carefully consider whether such trading is suitable for you and will depend on your specific circumstances and financial resources. It is possible to lose all funds deposited with your broker and can even incur losses beyond these amounts. Please inquire at the link provided. For more information or for a copy of the full CFTC full risk disclosure. Also, please remember that these training webinars are not a solicitation nor recommendation, but simply educational in nature. This webinar is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to NinjaTrader Brokerage directly at the information provided. The NinjaTrader ecosystem website is home to hundreds of third-party apps, services, and all centered around the NinjaTrader platform. With new tools added to the site weekly, you can quickly search by keywords or filtered by trading methodology, asset class, and more. You'll also find information about the upcoming webinar and an on-demand video archive to view event recordings at the link provided. For up-to-date information, be sure to like or follow NinjaTrader ecosystem on all social media. I provided both our Twitter as well as our Facebook link in the room. NinjaTrader is always free for advanced charting, strategy, backtesting, and trade simulation. To ensure you are on the latest version of NinjaTrader and pick up a free live trial, please visit the following link. You can purchase or lease NinjaTrader at the following link. And if you are just getting started with NinjaTrader, we offer free live training on a daily basis. You can view a schedule of weekly webinars at the following link. We are very excited for this unique event in which David of Polaris Trading Group will discuss how to effectively identify price range extremes based on upon repeatable rhythmic patterns. Thanks again for your attendance today, and without further ado, it is my pleasure to welcome to the NinjaTrader webinar room, David. Please take it away, David.
All right, thank you, Tiffany. I appreciate that. All right, welcome everyone. Give me one moment. Let me get the chart share going so we have the right screens. Okay, let us know if that looks okay, and I'm gonna, let's see, now I need to pull down, Tiffany, the chat. Oh, I have it right here. Very good. Good. All right, looks like we're in business. All right, good afternoon again, everyone. Welcome to today's event, and I appreciate the time everybody's taken to come visit with us today, and hopefully we'll walk away. I'm sure you'll walk away with some new information and that you can take forward with you with your own trading. I see some familiar names already in the list, and some of our members actually, our PTG members are with us. That's great, and I see a number of new names that I'm not familiar with. So again, welcome to those folks. So today, let me ask a question first, and if anybody, a poll, I guess. How many of you in attendance today have ever heard of the 3-day cycle or tailor trading technique? If you can just put a yay or a nay in there. All right, all right. Let's see, what do we have here? Okay, all right. Many of you haven't, some of you have, looks like, okay, somewhat mixed. All right, great. Okay, the 3-day cycle is not really a popular concept out there in the retail trading community. That's why I myself have been trading it for 10 years plus, but I want to bring it forward to the trading community and bring it to much more visibility. Other techniques, you know, again, you have the Fibonacci's of the world and the Murray maths and all those, you know, profiling and whatnot. Most people are more familiar with, but the 3-day cycle is something that is kind of just never really heard of it for a lot of folks. I will tell you though, a lot of trading professionals, hedge funds, mutual fund money managers have heard of it, not only heard of it, but they employ their techniques on a daily basis in a lot of their work. How do I know this? Because I've worked for the investment banks. All right, so let's move on. All right, again, NFA compliance rule 2-29. Of course, everybody has seen these disclaimers before, so no different here. PTG, Polaris Trading Group, offers services and products for educational purposes only, on a subscription basis, and everything that you'll learn here today and in our membership, if you decide to join, should enhance your trading performance, but past performance is not indicative of future results. And of course, as Tiffany mentioned earlier, you can lose all of your investment capital trading futures. So be sure you trade with funds that you can afford to lose. Okay, so who am I? My bio, David D. Dube. I'm a 36-year trading veteran. I've worked for various hedge funds and investment banks over the years. To name a few, Shearson Lehman, United Bank of Switzerland, and some high-frequency hedge funds. During those years, I was a market maker, and I traded index futures and derivatives. I traded NASDAQ and listed stocks, and I was involved heavily in portfolio risk management. So I was a market maker in the old days where we did a lot of this stuff by hand. Today, everything is done via the computer. Although we did use the computer, it wasn't to the extent that is being used now. All right, but again, that was what I did as a market maker. All right, so there we go. Polaris Trading Group, what's my mission? What's our mission here? Okay, and some of the benefits of our trader training service. So just a four-pronged mission. We want to improve your decision-making skills, number one. A lot of traders have difficulty making decisions. We drill that down. We have specific criteria and teach our traders how to make decisions and higher quality decisions. We also want to help them learn empowering trading habits. Too many folks have bad habits. You probably are aware of some of your own habits that you would like to change. Certainly, we encourage our members to improve those habits. We give them techniques on how to improve those habits. Demystify market action. Now, this is kind of an open category, but a lot of folks are somewhat confused at times on why the markets do what they do. And again, part of the education that you'll get at Polaris and what we'll talk about today is to help demystify that. The markets actually have good form and function. And so with that, we want to be able to uncover the highest quality type of forms and functions and structures that put the probabilities on our side. And then lastly, we want to become a more informed trader. Okay, so there's, some people call different groups of traders professionals and then retail. Okay, I look at it differently. I look at it that they're a group, either you're of the informed group, okay, and that does not mean inside information, but rather the informed group, understanding how the market, functions, and then you have the uninformed traders, all right, that are just not quite up to where they should be. I've known a lot of people over the years that trade and manage a lot of money. I would actually categorize them as uninformed, which is a little scary to think about. But at the same time, a lot of our members there, we're all of the retail group at this particular spot. Perhaps some of you are commodity trading advisors, as I am, and you are trading other people's money, so you are in a category of professional. But in all cases, we want to make sure our traders are informed. Get the right information, the right decision processes, work on improving your better habits, all right, and so forth. So that's our four-pronged mission for our members. Okay, let's get right to the subject. What is the 3-day cycle? All right, it dates back in the early 1940s, again, by the gentleman by the name of George Douglas Taylor. And it was simply a short-term way of trading, the markets. Now, I believe he traded, if I'm not mistaken, wheat and corn or soybeans back then in those days. And so again, everything, he was in the pits. And what he would observe is certain groups of traders. Now, of course, back then, everything was physical in that you could see everyone. Today, we don't see anybody on each side of the screens. But you could see it. He could see everyone, and he could see those folks that what he would designate as smart money or the big institutional folks. And he would, and then, of course, you'd have your locals. And so in the pits. And so what he would do is and he's a local, so what he would do is he would focus on those folks that had the big money, all right? What were they doing? What actions did they take in the early part of the session, particularly in the latter part of the session, okay? What was the range of the day? What happened on that day? So he created a book. All right, and again, physical book where he logged in painstakingly all these observations, and really that's what they were. Initially, they were just observations. So he would the collective action of all these so-called smart money folks. All right, he identified that there were patterns that were repeatable. All right, and again, what we call these rhythmic patterns that go from extreme highs to extreme lows. And again, it's a repeatable pattern. Okay, and what he observed was these patterns not only repeated daily, but they repeated every 3 days. Okay, again, on average. All right, so the cycle itself is 3 days, as we, in its purest sense. But again, sometimes there's a flex day there. But for the most part, it's 3 days. And the way the structure goes is the way he identified them initially. Now we call them cycle day 1, cycle day 2, and cycle day 3. But the original names by George Taylor was a buy day, a sell day, and a sell short day. Okay. So basically the premise was that these big money folks would come in and they would drive prices to the extremes. And then they would, again, think about the informed traders and think about the uninformed traders. Okay. So they would drive prices to levels where they wanted to buy them. So on a buy day, the core premise on a buy day is to drive prices lower. Okay, so it seems kind of counterintuitive at one point. Well, it's a buy day, and why are they selling it? Well, the goal was to drive prices lower so they can buy from the uninformed traders and less capitalized traders out there and buy them as low as they possibly can. At that point, once they've done that, then it becomes the markup period, right, which is the cycle day 2. So cycle day 2, they would begin to then drive prices higher. Now, everybody, if you keep in mind, everybody has either sold out longs or perhaps even initiated shorts near the lower end of the prior day. Of course, those folks that are on wrong-footed, they become buyers. So they use the strength of the shorts or the wrong-footedness of the shorts to drive prices higher, and then that accelerated prices back higher. At some point, that would stop, consolidate, back and fill. All right, so basically, cycle day 2 or a sell day is they'll take some profits, but they basically don't want the pattern to break down. So many times the cycle day 2 is more of a consolidation type day. All right, and so once they've determined, again, they being the big institutional folks, right? Once they've determined that there are no more sellers, all right, that drove it down, because they were the sellers the day before, but there aren't any residual sellers out there, all right, and they would begin then towards the end of the day on a sell day or cycle day 2 to work prices even higher. And so the goal there is to penetrate the prior day's highs. On a cycle day 3 becomes what we call the sell short day. So what they're looking to do is drive it even that much higher. Again, get those shorts to capitulate. They're selling their longs into that type of buying. The buying begins to dry up. What the smart money then does, all right, and again, once prices have reached these cyclical extremes, and again, we'll talk about the ranges about how to identify that very shortly. So that's the core pattern, right? Rally from, find a cycle day 1 low, rally from the cycle day 1 low to the cycle day 2 high, right? Once that's in place, they, of course, try to drive it a bit higher on the cycle day 3, unload all their positions, begin to take short positions, and then drive the price back down once everybody is trapped long to the upside. Now they want to drive it back down, and again, the cycle kind of begins over and over again, right? So the decline from a cycle day 3 back down to a cycle day 1 low. So that's the core premise, right? Why do they do this? Simply because they can. All right, so some of the terms that you'll encounter with this concept and this strategy is violation and penetration. So think about a violation is what you want to do is the sellers, the smart money wants to force a low, the previous day low, force a violation to create panic selling. All right, to get those longs out, all right, because they, again, typically there'll be sell stops underneath the market at some level. They want to drive prices to those sell stops. Lo and behold, all right, knocks out the sell stops, all right, creates an excess low. And again, many of you profile folks have heard the term excess low. Create an excess low, scoop up all the weak sellers, and then again, that cycle kind of continues. On the flip side, going from a cycle day 2 to a cycle day 3, the goal there is to push it even higher. So they want to force what's called a penetration. So you're penetrating the previous day's high, and then again, push it to extremes. And once again, right, shorts scurry, right, they have to cover. You got folks that are, buying the breaks of the prior highs. So for some momentum plays, and again, in the big money, the smart money, what they're doing is they're pushing it up and they're selling it. So who's the big money? You get institutional folks, you got the big hedge funds that, again, the group that knows how this cycle works, okay? Now, granted, this isn't the only cycle or activity that's taking place out there, right? I mean, again, there's market profile concepts, there's all these other various things. This is just one microcosm of what's going on. But when you take the concept here that George Taylor observed back in the 40s now, all right, this has really held the test of time. And what's interesting about this is the levels that we calculate, all right, through what we call the EBook or the electronic book. All right, we have an EBook version of what George Taylor did physically on paper. The levels that are calculated are based upon actual observations. This is much different than a Fibonacci calculation, 62% or 127%, et cetera, the golden ratio type of thing. This is all based upon actual trade activity that's taken place. All right, so it's really market generated information rather than just an estimate or, some kind of esoteric calculation. So this is what professionals out there use, at least one tool of it that they use, and again, these hedge funds and money managers use this. So basic context and assumptions. Again, the end of the cycle offers the greatest opportunity, risk and return at the best point. So in other words, what we're looking to do, right, and what professionals are looking to do is, again, drive it to the extremes. Once we're at those extremes, that's where George Taylor determined that's what the big money was doing. They were pushing it to these extremes, and then they would take the counter position, and then they would be the ones that would be winning all the time. So they're trying to enter. Again, this is different than counter trend trading. This is not related to counter trend trading in any shape, way, or form. What they're looking to do is find an extreme, get positioned from that extreme. We'll talk about how to position there shortly. So the excess extreme marks the end of the cycle and the beginning of the new cycle. So these are some of the core premises, all right? We talked a little bit about this already, the violation penetration. This kind of goes into a little bit more detail about that. Again, markets has a tendency to exceed previous highs and lows, and the results of the penetration of violation. So again, there's some residual momentum that occurs, and once those levels are in place, again, the markets tend to back off from that. And we had some great examples today. I'm going to show you a live chart from today's session that actually demonstrates what we're talking about in a large way. So if the market closes low in its range, so this is kind of the idea is okay, so you have the range of the market, 30 points, 35 points, whatever it is. Where did the market close? Did it close, in the middle part of the range, balanced? Did it close to the upper or lower part of the range, unbalanced? Okay, what was the tendency at the end of the day? Remember, so when George Taylor was in the pits, he was looking at the activity of these large money traders, and it wasn't what they were doing midday, more so what they did at the end of the day. Okay, so how did the market close? What type of momentum did the market have at the end of the day? All right, and so that became always, and I'm sure everybody's aware of this, but the low or the high of any day is a key reference point. And what happened at the end of the day? So did it, where did it close in its range? All right, and it's important. And each day has an idea, each cycle day has some criteria about where the expected close will be. All right, again, not being predictive, but just looking back historically, what would be the tendency on a cycle 1 or 2 or 3 day. All right, so then the idea then is if the move generates a violation or a penetration of that reference point, the question becomes, does that violation or penetration, meaning the move above or below the prior high, is that accepted or is it rejected? Okay, and these are some core things that you should probably be asking yourself already, even without knowledge of the 3-day cycle, is what's happening at these? Is the market accepting this level? Because if the market is accepting a level beyond the prior range, then the probabilities then begin to favor further expansion beyond the range. But if they just push it up and the market doesn't have support for that upper level or lower level, the markets will then get rejected. All right, it'll reverse. So we need to measure at what point beyond the prior range, beyond the prior day's range, is the market more likely to find a support or resistance reaction. All right, what we would call an automatic reaction, and we're going to show that today. All right, so if the price is rejected, it's going to come back into the range, and the market will be looking for a reversal. Okay, again, if we're going a little bit fast on this, don't fret on that if you don't understand each part of this. Just kind of absorb what you can absorb, because as we move along, again, there'll be an offer to come in and trial what we do. You'll get more information, to be able to see it in practice. So again, let's specifically go into the cycle days. Okay, so on a cycle day 1 low, the main idea here is to find a secure low. Once they find a secure low, all right, we're going to they're going to absorb all the sellers, any residual sellers that may unfold, and then the goal then is to push it back higher. So again, many times the market on a cycle day 1 low is selling, and many times a lot of people are short selling. All right, and at certain points, when it reaches its extremes, then the idea is the market will reverse. So here's a graphical idea of this. All right, so it starts over here on the left, which is the cycle day 1, right, which actually begins from the cycle day 3 high with the end of the prior cycle. So the new beginning of the cycle is the cycle day 1, the left part of the panel, and you'll see the idea is the push prices lower. Okay, so past the cycle day 3 low, which is violated, which forces longs to liquidate. All right, down into the projected what will have an average decline or a range that we would that the electronic book calculates. And again, we have all of that in advance for the next day. Okay, and once that low is established, all right, so again, selling has begun from the cycle day 3 high, and they push all the way down. So point 3 is they reach, ideally, they reach the projected average of decline. Once that average decline is achieved, then again, the smart money then begins to absorb all the excess selling, all right, and then begins to now push it higher. Okay, so from a cycle day one low, which is 0.1 over here to the left, all right, again, now this is now what I'm describing here is an idealized pattern, okay, and in many cases it will unfold in similar ways, all right, but the concept is the same as each cycle unfolds. So once a cycle day low, a cycle day one low, or remember it's called the buy day, so the idea is to be able to push it lower, to be able to buy it as low as possible. Once that's established, the goal is then to rally from the cycle day one low into the cycle day two. And again, there's an average range projection for a cycle day two high. Okay, and as a matter of fact, today was very interesting. We reached that objective today into the close, and we'll show that in a moment. Okay, so again, cycle day two from a cycle day one, pushing it up. Now, as you can see here on a cycle day two, the mid part of the panel, it's somewhat of a consolidation day. And as I mentioned, cycle day two typically, all right, acts as a consolidation day. And in this particular example, price could not make it above the cycle day two high on the cycle day three, so the third part of the panel here on the right. And then as such, they attempted a breakout of the prior high. They failed. Remember, that was a rejection now, okay? And then the market rejected any attempt to move higher, okay? But keep in mind, the smart money had already been selling most of that during the cycle day two into the cycle day three. So the attempt to move it higher failed, and then the next decline ensued. All right, so again, kind of just continue with the same graphic to visually outline what we're talking about. Is failure or rejection of the cycle day two high. Smart money is now establishing short positions. So in this area over here to the right, where during the Globex session and into the RTH session, they could not get it any higher. So the smart money says, okay, we're going to start getting more aggressive, right, to not only liquidate the balance of any outstanding longs, but to get short. Once again, trapping latecomers, right? The latecomer longs, thinking that the market is going to move higher. They reject that, okay, and then of course, and they force the violation then of the cycle day two low. So it's important to understand this violation penetration idea. But once they force that low, all right, then the further decline begins to unfold. Okay, so that's what happens next. So this is kind of the idealized. All right, I just answered someone's question. Okay, great. I'll get to the questions in a moment. We'll have a period for questions. I want to make sure we get through the core part of the presentation here. All right, and let's see some final comments. Right, and we're getting close to the end here, so we're in good shape. We know that the 3-day cycle is basically a high minus a low. So basically, this is a little ancillary information, but bottom line is that there's a 3-day cycle rally has, I think it's a little bit higher than 84%, but we'll go with the 84%. I think my partner Rich said it's somewhere closer to 90% now. But the idea of a positive 3-day cycle, what constitutes a positive 3-day cycle? So if you think about the cycle day one low, that's the big low point of the beginning of the cycle. All right. So the idea simply is this. All right. I'm not going to go through all the text there, but I'm just going to explain. The idea is this. Once the cycle day one low is established, that's the beginning of a cycle. All right. Then you go into cycle day two and three. By cycle day three, if price is above the cycle day one low, it constitutes what we refer to as a positive statistical or positive cycle statistic. Okay, so as long as price is above the cycle day one, or it's also the buy day low, it constitutes a positive cycle. If on a cycle day three, price is below, closes below the cycle day one low, there's a potential failure of that cycle. Now again, the market's inherent bias is bullish. Why? Because mutual funds drive this market, and they're primarily long only, right, mutual funds. So there's an inherent bullish bias. So the idea of having a positive 3-day cycle is the odds are very high that on a cycle day 3, prices are going to be above that cycle day 1 low. That's important to understand because it can drive how you end up trading the cycle. If you know that the statistics are favorable 84, closer to 90% of the time, that we're going to be above that cycle day 1 low. So it's important to establish a position near to or possibly even below the cycle day 1 low so we can establish a position. All right. Okay. So lastly, the ebook. All right. As I mentioned, George Taylor wrote everything in a hardbound book. Okay. Now I have a partner by the name of Rich. He's out in Europe. He's actually created an electronic book version. Now he's been doing this. He and I have been collaborating on this now for a few years publicly, but I've been working with him for 10 years, and we've been trading this together along with a number of his clients as well as my own for 10 years. So over the past 3 years, we've been beginning to bring this concept to market more and more, get more people to learn about this cycle because it's very powerful. And again, nothing is 100%, but if you start understanding how the markets function in a way where somewhat different than just Fibonacci type style traders, it can add a piece of a puzzle that may be missing. And and again, trying to understand that the smart money being simply the big institutions, they're the ones that drive this, not you or I, all right, or even moderate, capitalized people, but really the big guys, all right? So we need to understand what they're doing. So what he's created is he's created an ebook, and here's an example of it, all right? And part of the bonuses that we're going to offer everybody today at the end, and I'm going to put some links up there to join up. We're going to offer a 30-day free trial, all right, no cost obligation to come in and visit with our trading room for 30 days. Typically, I charge $99 for 2 weeks. Again, special offer, really just blows out, what we've been doing in the past. And in addition to that, you will have access to the ebook. Okay, we will pass that out. I will pass that out on a daily basis to any of the webinar attendees that decide to join up and come and visit with us for the month of February, the entire month of February. All right, you'll be able to sit with us. We'll discuss the 3-day cycle on a daily basis, and we'll show you the levels, and we'll show you how to trade it, et cetera, et cetera. All right, so let me put up a link because I want to get the link up here. All right, before we go any further, and before I run out of time, I think we're good on time. Paste. All right, so here's the link, everyone. Be sure to bookmark that, or click on it right now and sign up. This will bring you to a landing page, and just fill out the information that it requires, and just purchase it. Now, again, the purchase is free. You won't be charged anything. Okay, so be sure to do that. And again, you'll have a 30-day trial to our trading room. Plus, we're going to give you access to the 3-day cycle electronic book as well during that trial period. Okay, so be sure to click on that. What I want to show you today is, and if you start having any questions, feel free to post them up there. Here's what I want to show you. Today, this is today's action. All right, now there's a lot of levels here, so don't get too dismayed by the levels. But here's what we had. Today, the market, this is cycle day 2 up here. All right, so cycle day 2. So again, on a cycle day 2, what's the goal of a cycle day 2? All right, is to rally from the cycle day 1 low. But today was a little different. We had again, all this action about the coronavirus panic and scare that's going on out there. Okay, so the market was certainly spooked, all right, in many ways. And so the market here, you can see this red line here that says BDL or buy day low, which means it's the cycle day 1 low. Does everybody see that? Should be able to see that, 65 quarter. So that's the buy day low. So the goal is, to be able to rally from that level. Okay. Well, as a result, what happened today, this morning, and during the overnight, about the scare of the coronavirus, all right, the market did not rally. It went lower, even further. Now notice, all right, even though it goes lower, okay, there are some statistical levels that the EBook generates automatically. All right, some statistical levels. So this green zone that we had here today, roughly between the 44s, 32, 44s, and 46s on the ES, as you can see, buyers started to come in here, all right, and essentially price found support after, these are 60-minute bars, by the way, after a period of time. Now, it took certainly some time, but each time the market came down and tested this level, this zone, all right, you can see some of the long tails that were generated on the candles. Now, again, keep in mind, this was also near the January 27th pivot low. There was some high volume in this area on the profile. So they're, again, overlapping with some other ideas, concepts. But we had these numbers here, what we call the violation low. All right, so that's what we call a statistical extreme. So if the low is violated of the buy day or the cycle day 1 low, what is the decline? So the average decline, an average violation decline is right here. Okay, 52 to 50. Okay, you can see where it says average, AV, MAV. So that's the average decline, but prices can go beyond the average, and when they go beyond the average, they hit our statistical decline. Okay, so again, so how do we trade this? This is the goal here. The whole nature of this webinar is to identify the edges of cycles where there's an edge for the institution, right? And again, whether it's a mutual fund institution or it's you, Joe retail trader, okay, we want to make sure we want to be able to identify a level or a zone. So how would you trade this? All right, now if you're trading straight out futures, you can buy it. All right, nothing, if you have the capital to do that. A lot of our members, a lot of our users of this technique actually buy call options. So we have these 3-day call options, right? Usually most everybody uses a 3-day cycle call option. So today, coming down here into the 45, so they may have bought the, what is it, the 324s or the 325 call option. All right, and again, we would typically, though we don't advise specific trade ideas based upon the cycle, more we teach the cycle, but the one way of our members and subscribers use it is to buy call options. So today, buying a 324.50 or a 325 call option for the next 3 days, essentially you're buying lower premium with inherently greater potential because you're at the edge of you're at the statistical edge of a cycle. So today, look what happens. All right. At the end of the day, again, a lot of action with that corona news today. At the end of the day, strong rally ensues, takes out the buy day low, 65 quarter, right? So remember, what's the goal of cycle day 2? All right. Well, the goal of cycle day 1, and in this case, also cycle day 2, was that find that low. So they found the low early in the day, right? Early. So 11 o'clock, you can see here, 11 a.m. They found it in the morning session. What did they do at the end of the day, which is the most important part? They rallied it, and look where they rallied it to. All right, 92, 75. Okay. Excuse me. Let me show you the actual spreadsheet today. All right, coming into today, Thursday, January 30th. Possible high for cycle day 2. Yeah, I'll answer that in just one moment, Alan. All right. Possible high for cycle day 2, 32.92.59, right, based upon an average rally. So the market ultimately reached its average expected rally on cycle day 2. Now, again, the way you get these levels to answer Alan's questions is, again, Alan, if you haven't yet already, click on that link that says Trade Chat ME PTG. All right, join up for 30 days. All right, join up with our trading room for 30 days. All right, visit with us for 30. Okay, and what we'll do is once you're on the list, all right, beginning Monday, I will send everybody a copy of the levels. Okay, the evening before. Terrific. The evening before. All right, so you'll have it in your inbox. We usually have it in our inbox by 5 to 5:30 Eastern time. And so for those trading the Globex session, Nikkei, Shanghai, everybody will have these, everybody uses these levels. So they're good for 24 hours, all right, from, starting from Globex. So Rich, my partner who creates the ebook here and sends it out to everybody, he's in Europe. So he's up around 11, 12 p.m. Doing the spreadsheet for everybody. And he sends it out. But again, remember, keep in mind, this is not predictive. All right, we're not trying to predict that the market is going to. One thing I learned years ago is that, and again, I learned this from my days at the investment banks, the markets inherently want to what's called satisfy the range. Okay, and what is that range? It could be a 10-day average true range. Typically, that's one of the satisfactory ranges that people look for. Another one is this 3-day cycle range. Okay, and you'll see here, we actually have a separate training video on this to read the entire spreadsheet. So again, don't be too concerned about what you're looking at right now, but just understand that everybody receives this at the evening before, and there's only certain sections of the spreadsheet that you really need to focus on. And again, there's a training video that will show you how to do that. So during your visit with us, we'll be going over that in much more detail. And so you have a really good idea of how to use, how to interpret, all right, what this is all about. Yes, so the question was by Eric, do you also have it for oil? Yes, we have it for oil. Do I have an oil one up here? I think I have an oil one up here, if I'm not mistaken. See if I can, let me see. Yes, I do have an oil one. It's on the other screen. So we have it for oil, gold. We have it for currencies. Again, for the most part, we have the metals. All right, all the metals, heating oil. So if you're interested in that, again, I will be passing out the E-minis as well as the oil and gas. Any other indices? Yeah, so what we use here is the core ones are the ES, NQ, YM, and Russell, all on this particular spreadsheet. Yes, we have YM. Okay. So if you want to follow YM, again, once you understand the concept's the same. Okay. And the spreadsheet will be interpreted the same way. So then we have oil. All right, we have gold, again, heating oil, natural gas, anybody that trades natty gas. All right. All right. Yes, is there an app associated for this? Absolutely. Okay, so once we have the spreadsheet here, let's see if I can get back to that graphic. Let me just minimize this. There we go. This particular, so we have an indicator, all right, that plots all the levels on NinjaTrader. Okay, so it's a nominal fee. You won't be able to have access to that during the trial, but at the end of the trial, if you decide you want to subscribe to the service, it's a nominal, for the service itself is nominal amounts like $49 a month. All right, there's some information on our website regarding that. Ninja 7 or Ninja 8. Also for Sierra chart, if you happen to use Sierra chart. So we have it for Sierra, Ninja, and Ninja 8 and Ninja 7. I think everybody's migrated over to 8. So we have that. This is Ninja 8, as you can probably attest. All right, so again, these levels are not predictive, but the idea is you want to ask yourself the question, what's the potential? If this statistical low, all right, if this statistical low holds, what's the potential of it reaching, these upper levels? Okay, so again, the goal is establish a position. Again, via options is usually a more effective way to do that. You can hold the position over the course of a few days, all right, and typically the idea, this one happened to actually burst up in one day, but if you hold a call option or in the event of a short, you want to do a put option, but most of the time we're just primarily looking to trade calls because the inherent bullish nature of the cycle, okay? Not to say that puts won't work, but the calls tend to work much, much better. How accurate is the software? Well, the software is, again, remember, as I just mentioned, it's not predictive. What it's designed to do is show you the ranges that historically have been recorded, okay? And again, there's some formulas that the EBook generates and how it generates the level. So I know the potential for today was 32.92.75. That's potential, okay? All right, that's about it. I think we're coming up to our time. Let's see. I know. Let me just quickly. If you guys have any, we're going to end up a webinar right here. But if you guys have any questions, all right, again, I'll be happy to answer everybody's questions throughout the course of the. If I didn't get to them today, because there's a lot of questions I probably didn't get to. All right, let's do that in the trading room. Okay, we'll hold some breakout sessions over the course of the month. Okay, could you say again what the goal is for day 3? Quickly, the goal for day 3 is to exit all of long positions and to then begin establishing short positions. That's the primary goal. Okay, once certain extreme levels have been achieved. All right. All right. Again, our room schedule, again, is 9 a.m. or 9:15 a.m. all day till 4, every day, 5 days a week. All right. All right, guys, thank you very much for your attention. Hopefully this was there's a lot of information packed into today's webinar. You'll be able to learn more about it and work with it over the course of the next 30 days. So be sure to sign up, and we'll do a lot more work with it over the next 30-day period. Yes, everything is Eastern time. All right. Great. I look forward to seeing everybody there. Thank you again for your attention, and I will pass the baton back over to Tiffany. Thank you, Tiffany. And thank you, everybody.
Thank you, David. So I'd like to give a special thank you, obviously, to David of Polaris Trading Group for a great presentation. Everyone in attendance here today will receive an on-demand recording of today's event, so just keep an eye out for that email. NinjaTrader Ecosystem is pleased to sponsor these weekly vendor events as a value-added service for our clients. So if you find value in these events, we hope you will attend them on a regular basis. You can view all upcoming and past webinars at the link provided in the room. We would like to remind you the information provided in this was that of Polaris Trading Group and not of NinjaTrader. All information was for educational purposes and should not be construed as trading advice. Again, we appreciate the time you spent with us. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us at NinjaTrader Ecosystem. And again, thank you so much, David.